The Consumer Price Index continues its steady decline from the 41-year high it reached a year ago. That's good news, but does that mean inflation is no longer an issue? Probably not yet. Last June, the Consumer Price Index moved above 9% for the first time in more than 4 decades. Once it reached that high level, the rate of inflation began to decrease, and it has been decreasing ever since, 10 straight months in a row. As of April, the Consumer Price Index is down to 4.9%. That's good news for all of us, of course, but the trend of steadily decreasing CPI doesn't mean inflation is over yet. A closer look at recent price data shows we may be starting to see the emergence of so-called sticky inflation. Inflation that may no longer be acutely high, but stays higher for an extended period. Economic uncertainty means you have to keep up with what's happening. Make sure you subscribe and we'll keep you in the know. Signs of stickiness are showing up now in the data. The thing to look for is acceleration of the rate, even if slight. The pace of headline CPI in April did slow to 4.9% year over year. However, the monthly figure re-accelerated by 0.4% after coming in at 0.1% in March. We see that core CPI has been especially stubborn. This is the rate that excludes volatile food and energy prices. In January, year-over-year core inflation was 5.6%. By April, it had improved just 1/10 of a point, 5.5%. Then there's the Personal Consumption Expenditures Index, or PCE. This is said to be the Fed's favorite inflation measure because of how often its basket of goods and services is updated. Headline PCE was up 0.4% for the month of April. That was the fastest monthly pace in 3 months and well above March's 0.1% increase. As for what lies ahead, nobody can say for sure, but both analysts and consumers anticipate persistent inflation ahead. The Conference Board's latest forecast says inflation won't return to the Fed target level until the end of next year. Economists at Fannie Mae believe inflation will remain above target at least through the end of 2024. Respondents to the latest Michigan Consumer Sentiment Survey said they expect inflation to still be above 4% a year from now and above 3% 5 years from now. This can be a problem in itself, as Scott Russ-Roltz of Insight explains. When inflation expectations get too high, they impact the actual rate of inflation. Consumer respondents to the most recent Federal Reserve survey on household well-being said inflation is their main financial challenge, and 54% of respondents said their budgets had been impacted a lot by inflation. Economist Mohammed El-Arian called these consumer survey results sobering, and he added, "It is yet another indication of how much inflation has undermined the financial security of Americans." All of this is a concern, in part because over a 20-year period, inflation at just 4% can reduce the purchasing power of retirement savings by more than half. It's a good idea for Americans to be aware of changing rates like this and to learn more about what is happening. That's why I suggest you take the time to learn more about what's really going on in the economy by attending our exclusive one-on-one web conference at AugustaPreciousMetals.com/webconference.